Thank you for having me, and thanks everybody for showing up today. Did he leave me?
I'm on mute. It's your show.
Okay, good. Okay, it's our turn. Oh, turn me loose then. Turn me loose. All right. Again, thanks everyone for showing up today. I got a great topic. I know it's a great topic because so many people want to know about what's these indicators, what's the best indicators, what are these trading indicators that the big pros use, and I'm going to try to shed some light on this. So again, thank you. Now, before I do get started, I don't know if some of you follow me on social media or you are active on social media, but if you are, I'm constantly posting ideas and trade stuff and doing videos on YouTube and everything. So on this screen right here are my Twitter handle, my Facebook handle, and my Instagram handle for those that want to check that out. I want to kind of set the stage just a little bit as we talk about indicators, because this is a very, very touchy subject. And I want to just set a few things straight before we even get started. And that is that there is not a holy grail when it comes to indicators. And I'm pretty sure that most of you know that, but it's easy for us that when we're struggling with trading or we're having a lack of consistency, that we're looking for something to tie it all together. And then sometimes it kind of turns on us, and then we just kind of reach out for some sort of help and just start getting hopeful and hoping that there's something out there that's going to solve our problems. So no indicator is going to magically transform your trading overnight. So if you suck right now as a trader, a couple of indicators on your chart's not going to solve that overnight. It can help you position yourself better, but it's just a small piece of what it takes for a trader to be successful over the long term. So if you're really struggling with things like consistency, perhaps this will help, but you'd also probably need to take a deeper look at some of the things that are going on in your trading business. Now, the way I look at indicators are probably a lot different than many other traders. As I said, there's not a holy grail, but to me, indicators are only used to either confirm a decision, reassure a decision that you have already made, kind of help you out with figuring out a profit target, or an early clue to a wrong decision that you may make. So kind of remember that as we're talking about these indicators. I personally don't use them to confirm a decision. Like when I'm ready to make a trade, I don't necessarily base it off a series of indicators. But remember that as we go along. What they're there for is not for perfection. It's just a process. It's process, not perfection. And it's just there to help you confirm a decision that you've made, reassure a decision that you have made. Sometimes you find yourself with your back against the wall, you're being pushed around a little bit, you're not sure you made the right decision. Indicators can help you with that. Some of you may sell your positions too early or cover your shorts too early and constantly complain about leaving a plethora of money on the table. I mean, we've all been there. If that's a chronic problem, a lot of it has to do because you're not using the right indicators. You're not letting that trade manifest to what it really could be. And one of the things that really separates the professionals from the amateurs is not so much how many times they're right and how many times they're wrong, but a key to being a great professional or very successful trader is the quicker that you can realize that you are outplayed on this trade or you've made a wrong decision, the faster that you can recognize that and cut it and get out rather than hope that it turns in your favor. That's going to go real far. And just to kind of solidify that, if you guys could go back into your brokerage accounts right now and you could just have 1 or 2 trades taken out every month, just if somebody would pay back those 2 losses, I mean, just think about how much different your trading would be. I mean, how much better would it be if you could just have like a pass on 1 or 2 of your worst trades? So again, the key there is to get out when you're having a wrong decision. We're going to talk about my 3 favorites. And again, this is just my viewpoint and what I've learned over 2 decades of trading, what works for me. You may find none of this to work for you whatsoever. Or I would always suggest if you have something that's working for you right now, please don't let me or anyone else change your mind, because trading is a fickle business. If you found something that works, stick with it. There's no magic formulas. There's no secret indicators. We all can take different paths up the same mountain. If you found something, stay with it. But if you're struggling here a little bit, or maybe you're using some of these, maybe this webinar can kind of shed light on how I use them and how I look at things, and maybe that'll kind of open the door for you to make a little bit of profit. So these three that I use, the first is support and resistance. The second is VWAP. And the third is a series of SMAs. And if you want to write this down real quickly, the SMAs, I didn't put it down, it's the 10-period SMA, the 20-period SMA, the 50-period SMA, and the 200 SMA, if you want to write those down. And I'll show these to you on a chart, because what I want to do here today is show you how you use these for those entries, for your management of your trades while you're in it, and how you identify what an exit is and how you can work each and every trade the best that you can. So you notice I got support and resistance up there. And I know there's a lot of traders that would probably disagree that this was any sort of trading indicator to begin with. And I hope you guys can see this. I pulled up some charts here, some real-time charts. To me, this is hands down the very single best indicator that you could possibly use when it comes to trading. If you've got to stick with one, stick with support and resistance. Because if you're somebody who's trading by a chart, not a fundamental trader where you're reading balance sheets and profit sheets and you're getting into all that kind of profit margins and retained earnings stuff, if you're just a pure trader that's trading off of price action, like a day trader or a swing trader, and you're using charts, the purpose of using a chart in the first place is to decide where are buyers and where are sellers. I mean, that's really the essence of what it is that you want to know more than anything. Where do people buy this stock? Where will people sell this stock? When has this stock reached a point where everybody wants to own it? And where has this particular stock reached a point where everybody wants to sell it? And the best way to figure that out is through support and resistance, because that tells you exactly where buyers step in to help a stock, and it's exactly where sellers finally say, hey, this stock has gone too far, it's up too much, it's time for me to take profit. And I'm going to show you how you work through this. So we're going to just use this Apple. I'll open this chart up just a little bit larger, and I'm going to walk you through the ways that I use it. Now, depending on the kind of trader that you are, if you are a swing trader and you're a momentum trader and you're holding positions for a couple of days, it doesn't matter what chart frame you're using or what type of trader that you are. The fundamentals about how support and resistance and all these indicators work, it's the same. The only thing that will be different is what type of chart frame are you using. So for example, I do mostly day trading, so I'm on a 5-minute chart. Again, that's not the holy grail of charting either. That's just what I felt based on my strategy and the way I work. It fits my style the best. If you're on a 1 minute and it's working, great. Some use 30 minutes, some use 60 minutes. And if you're probably a momentum trader, you're using it daily. I'm just going to go through the webinar for what I use as a 5-minute chart. But remember, the principles are the same no matter what chart frame. So if you're doing swing trading, just do the same thing via the daily. How I like to start out every day is working with both highs and lows, starting from pre-market backwards. So if you're looking at this chart, you're going to see a gray area here. For those that use Thinkorswim, you know what this is. This is post and pre-market trading. The black highlighted area is intraday trading. So what I'll do is I will start from beginning to end and work my way backwards from where a stock will trade. And that's what gives me my basis. So you would start out with saying 184.30s here, if everyone can see what I'm talking about. Just right here, you got this little kind of like a double top right here in the pre-market. This 184.20s is your high. Then you go underneath of that and you start looking at pivot lows such as 183.05 and on down the line. So just to give you kind of an example here, I'll just draw some lines to help everyone out visually. And you should do this yourself each day when you're trading to find a couple of spots where a stock may trade. Now, this is something that you'll know, and what you may want to do for an exercise is try this when this webinar is over and just draw the lines out for the whole day, and you'll find it really, really amazing how a stock trades in or around these levels that you have drawn. So let's first start talking about an entry. Let's say that you're somebody who has decided that this is a stock you want to own and you want to buy it. So you start to see this sell-off come in early in the morning. You get a small pop, you wait for a couple minutes to let things settle down, and then you start to see this second bar dropping down here. Now, one of the biggest mistakes that traders make, and the reason I start out with support and resistance, is because much of your losses and much of your agony towards losing trades comes from buying and selling at non-relevant points. One thing you have to keep clear here is that most of the time, I mean most, not 100%, most of the time, stocks will trade from one level to the next level, then to another level, and then back to another level. They normally don't go straight up to another level and stay there, and they don't go straight down to another level and stay there. Remember, stocks don't go up or down, they go up and they go down. So they'll trade between one level or the next. So getting back on topic, if you're looking to long Apple right here, I hope I'm not skipping too quickly, but let's say this 183.50 spot, you decide, look, I really want it. I think this is a pullback. I want to buy this stock. Now, this might work out for you, but one thing that we don't want to do as well as traders is confuse luck for skill. When we talk about technical analysis and we talk about our trading, we're talking about our body of work. We're not talking about this one time it worked or this one time that setup worked. We're talking about over 10, 20, 200 times. Does it work most of the time? And you'll find this to be the case with support and resistance. If you're buying this right here, you are really, if you're a technical analysis trader and you're trying to make a quick profit on a day trade, you're buying it at the wrong place. Now, that doesn't mean it won't go higher for you, but you're buying it at the wrong place. Because if you're under this theory that stocks trade from one level to the next, if you're buying this after it pulls back to 183.50, your next line of support is 183 even. So by all means, that's where this should go once this breakout has been rejected. So once that initial breakout gets rejected and it sells off, the next line of support should be this 183, and it stands above a 50% chance of trading back there. Now, if it doesn't hold this level and it trades back there, then you need to go back down to this 182 and then possibly all the way down here to where the overnight low was, which was 181. Now, the reason I say this is because as a trader, one of the things you're doing as well is you're planning ahead, not just using an indicator, but you're planning ahead with each trade that you're doing. So if you make the decision that you're going to buy it here, the next step is what type of losses may I incur if this trade does not work out? What may happen in a worst case scenario? This is something that I like to do, like prior to getting into a trade. I look at plan A and plan B. So what happens, it would be nice if it just broke out right away and shot straight up to 190, but that's probably not going to happen. If it sells off, what's the damage? What could this be? So if you buy this here, you realize that number one, you're too soon. Again, it might work, but statistically, you're too soon on this trade because it's not even at its first base of support. And if you do buy it, before this chart even turns bearish, remember, if you're longing it, that means you have a bullish perspective. So based on support and resistance, the chart doesn't turn bearish until it gets under 181. So if you're buying it at 183.5, you're giving up $2 to $2.50 of potential loss before the chart actually, in theory, has been broken to a bullish side. So by using support and resistance, that helps you with one of the main components. If you guys watched the DVD, the idea, execution, and management, is that you come up with a great idea, but then you screw it by having a very poor execution. And that support and resistance, when you're first talking about your entry needs to be as close as to support as possible. Because a big mistake that new traders, aspiring traders make is that they are buying stocks at high and selling stocks at low, when you should basically be buying stocks at low and selling them at high. Now, another reason for doing that is because you want to be able to capture the most amount of alpha, but that's a completely different topic. We'll just get back to this one. So as we trade a little bit further, you see it does kind of just stop here, right? Just take a look. It stops right at that first level right there, and it bounces. Now, a new trader would look at this and say, I don't know why it bounced there. Why is it bouncing? It must be going to go, it must be going green. It must be going to break out now that it bounced, okay? But the only reason that it did bounce is because it found its first level of support. Now, as your day progresses with indicators, they change. So in the morning when you're making a trade like this, you don't have much data to go on. We're only like 15, 20 minutes into the day. 90% of these trades are based on emotion. So we don't have a whole lot of data. But as the day goes through, you'll develop these support and resistance lines, and that creates what we also call the range of this stock. So it's not a surprise that it actually bounces there. So if you happen to have bought it as it hit that 181, it's 183 support, if you're back to that theory about stocks trade from one level to the next, and you're asking yourself after you've already entered it, wonder what I'm going to get, what's my prize for taking this fantastic trade, you would have to look at a possibility of getting back to this 185. That's the trade you would want to make. Now, it's not always a guarantee that it's going to go back there, but if not, what you're really looking for will be answered, and that is, will it go higher than 185? Because if it gets up there and it can't cross through that, and you see that rejection up at that resistance level that was established through the first candle of the day, that gives you all the information that you need for that moment, which means it's not ready. The market doesn't want it. And one of the things that we also have to understand about these indicators is that they're telling us the information that we need to know about our trades, about our trading plans, not what the world thinks. Because sometimes we allow our personal emotions to get in the way of this stuff, such as saying it should break out. This is a great setup. The world should know this is a great value. It's gone down too much. It's gone up too far. That's not up to us to decide. We can only trade these levels. That's why we use them. So anyway, to kind of fast forward here for the sake of time, is that what ultimately ends up happening here is that it does try to make that run back to the 185, and then it just doesn't have enough. Now, where this actually kind of come up short from 185, there's also an answer as to why that happened too. And if you just look, that was the highs from pre-market, right? Again, this is not magic. I'm not creating something out of thin air or seeing the future. It's right here in front of your face. It gets rejected at the pre-market high. It just was never able to get back up to this top wick. Now, after you have been rejected, not once, not twice, but 3 different times at that opening level, I think the story is right there. You have the answer that you're looking for as a trader, which is, what is resistance? It's 184.50 to 185. So however you want to sugarcoat it or however you want to present it to yourself, the bottom line is at this moment in time, maybe tomorrow's different, maybe later on in the day is different, maybe next week this is not even important whatsoever. But for right now, at this moment in time, for my trade, nobody wants this stock at 184.50 or 185. Nobody wants it. Neither do I. So when that happens, you have nowhere else to go but back where? Back down to the supports. So it comes back down into that first original support right where it started from. This time it's not able to hold, and then eventually breaks the first one, the second one right here where it tries to stop. And see, I hope you guys are kind of seeing this too. This is the beauty about support and resistance. You see, it just kind of comes down here and starts bouncing a little bit. Again, why would it bounce here? Well, that's a support line. And it doesn't have to be to the penny either, just some general area on the chart. And eventually it works itself all the way down into the low. It comes right down into 181, and that's it for the day. That's the low of the day. That's where it stopped. But eventually when this whole thing started, it couldn't find a bottom. until it got down into that gap, into the basic, solid, more relevant point of support. And that's where the buyers really stepped in, and that's where you saw a really strong move. That shows you the seriousness, because you didn't get that strong of a move here early, indicating that this isn't that attractive of a support, but you got a much bigger move down here. Therefore, you see a stronger move. So a lot of you probably want to know how you catch these big moves in stocks and how you catch these big pieces of a trend. And most of the time that doesn't come from buying it at high of day. You know, you're not wanting to be a buyer at 184 on an Apple. You want to be a buyer at 181, because maybe at 181 it actually ends up going back to 185, and look at all that you captured. Again, another topic there. I hope just from that you can see, just on just one stock, even though it looks minuscule, that's a lot of premium there. I mean, if you sit here, you could literally short this up towards resistance, which is 184, cover it down into the larger piece of support, which is close to 181. That's about $3 worth of profit, and then turn around and capture a bounce of maybe $1 to $2. So this little tiny move, just this little small patch of move that takes place in 1 to 2 hours of the trading session, could yield you up to $5 worth of total trading profit per share. I mean, that's enormous just on a small move like this. But the only way that you're going to be able to capture that is by being at the right spot in the chart. You have to be positioned well at the chart, because this leads to other things. By being positioned well in your chart, you have a lot of flexibility, because if you bought up here after these couple of bars as it was approaching resistance, as soon as it sells off, you have no choice. Practically, you have a choice, obviously, but really you don't have much of a choice. You have to cut the position, because you chased the entry, because you bought it as it was already ramping into resistance. And 9 times out of 10, 8 times out of 10, that's going to be a bad idea. Yeah, there'll be a couple of those squeeze through and make you feel good, but over a course of a trading career, you're going to be punished severely for that type of behavior, and it's going to cost you a lot. And of course, being at the right spot on the chart helps a trader avoid other disastrous things like accident. You guys ever been accidentally stopped out of a stop? Like you put a stop in and you got hit, you know, or it kind of dumped on you and you panicked and you sold too early. If you'd have held for 10 minutes more, you'd have made some money. A lot of those problems that we've all went through starts from just having the crappy entry in the first place, either bad size or bad entry or a combination of both. So when we start thinking about this, the key to support and resistance rules over everything, because it tells you exactly what you need to know. Where are buyers? Where are sellers? And based on that information, you can decide, based on this price action, how enthusiastic. So when you come down to this level right here, which was the opening support, there's a chance it could have held, and this thing could have turned out and broke out and made an all-time high. Stock's done that before several times. But you see, after a few minutes of trading here, it didn't really bounce that much. It was a very lame, let's say anemic bounce. And based on that, it's telling you that, yeah, there's buyers stepping in, but they're not really enthusiastic. Maybe I should wait. And of course, in this case, it paid off. And it works for anything that you're using. You know, the market did this kind of stuff today, where, you know, you have some overnights. I mean, look at these levels. You can draw it on any chart that you have. You know, like right here, you know, it held this solid amount of support. I mean, it's something that's real easy, and I'm sure that most of you understand it. And that's one of the beauty things about it. It's really easy to understand. It's easy to implement. It's amazing, though, on how many times we just overlook it, or we're not patient enough to wait to let it come back to where it goes. So this, you know, this is a Dow chart. It did the same thing all day here, pretty much. It traded within that range, right? You went up here in the pre-market. You sold down into that first level of support first thing in the morning. You ran back up to the pre-market resistance. You sold back down into the support. You rallied back up to the pre-market resistance, you came back in again, and then finally at the end of the day, you cleared that resistance, and the market melted up a little bit. Again, though, just look at this patch of time. I mean, how many trades or trading opportunities do you think are in here if you're on the right side? Problem is people are waiting too long for breakouts. You wait to buy up here, you missed it. You're already ramping up too close to resistance. And if you're buying too close to resistance, you're running that risk that you're cutting your profit short, you're taking away your opportunity, and you're putting yourself in a bad position. So remember, support resistance rules. How you use this can be several different ways, but pick a chart now after this webinar is over. Doesn't matter which one of your favorite charts, and just go back and start from the high of day, then the low of day, and look for any intraday pivot, like right here, any cluster of anything. So you would go this level here, this level here, and this level here, and just try it for a few days and to see how the stock kind of works around those areas. So just like real quickly, if you're looking at the market, if you gap down tomorrow and you want to know where's this gap down going to stop, because I'd like to buy some stocks or I want to see this thing turn around, well, you're probably going to get support from here. You're probably going to get support down here and maybe support down here. Now to make this whole thing short here, if you end up somewhere down here, you got problems. You have completely broken through all of the prior day support. So it's going to have to find another level, and you're going to have to go probably all the way back down here. So this kind of gives you not just 1 or 2 steps ahead, but sometimes 20 steps ahead. You always have another level that you're looking at. So you can see how, number one, it can help you get a good entry. Number two, it can help you understand that, look, nobody's buying this stock at resistance. It's haggling around too much. I should either pull some of my profits out or take the loss if it's small, move away from this, and come back later when I have a better deck of cards stacked in my favor. So it can help you in those regards. When things get ugly, a lot of people lose money. There's a lot of people that lost money Monday by panicking because they just freak out. They sell and ask questions later. And sometimes that's not the best thing for you to do, because sometimes you're doing that at absolute bottoms, at absolute solid long-term support situations, and that's just a nightmare. So support and resistance will always tell you everything that you need to know. It's number one. Carry that through with you. Now, I'm going to talk about VWAP here too. And let's see. Like I said, I never use stocks. I never use indicators as an entry, but that doesn't mean you can't. I normally use this one, this VWAP, specifically for an exit as a target point. Now, I'll give you the technical definition if some of you don't know what that is. And by the way, all of these indicators are just your basic standard indicator. I didn't put anything in them. So whatever comes from a brokerage account like Thinkorswim, I just use the regular parameters. If you happen to struggle with that and you can't get these charts set up right for yourself, send me an email, support@thelincolnlist.com. I'll send you the parameters just in case some of you have a little bit of programming trouble. It's pretty easy if I can do it. I think anyone could, but anyway, I'll tell you what this is. It's the volume weighted average price is what this stands for. And to the best of my knowledge, it's a combination of the volume versus the price. Where a moving average is like the price of the stock versus the time, this is the volume of the stock versus its price. Here's how I use it, or here's the definition that I have, this way I look at it. This is where the stock should be trading. Based on the volume and the price, this is where it should be trading. And the thing about VWAP is it has this ability. It's like the stock's long lost high school sweetheart lover. Like they find each other, or like those vampires when they bite someone and it's like, I always know where you are. That's the VWAP, because most of these stocks, a good 80% of the stocks every day find their way back to VWAP. So when you're starting out the day, you're going to have a handful of stocks that go above the VWAP and a handful that go down. And from there, 80% of these stocks are going to reconnect at some point before the day is over with that VWAP. So just by knowing this, you have an 80% probability here. Just by knowing this, that's telling you that this, like, one thing, there's only two things that are going to happen. Either the stock that you're looking at is going to, let's say it's going up a lot and its VWAP is much lower. Either it's going to stop going up and stay there until the VWAP can catch up with it, or it's going to come down into that VWAP. That makes sense? Now that doesn't work 100% of the time, but it's a good 75 to 80% of the time you will find out these things come back to that level. Now, I don't use it for this, but I do know a lot of other traders use the VWAP as a kind of line intraday for good versus evil. That stocks that are under the VWAP are bearish, and there's truth to that. They are bearish, and then stocks that are above statement. But the way that I use it for my trading, because mainly I'm a reversal trader, that when I'm either shorting a stock that has gone up or buying a stock that has gone down, one of my first targets is not just the next resistance, but it's also VWAP. And again, when you're putting these indicators on top of that, I'm not relying on just one. I'm just using it as a reference point, because sometimes that stock will trade back to resistance. Sometimes it won't make it to resistance, but it'll fail at VWAP. And then it'll come back down, and that's all I'll get. Sometimes VWAP and resistance happen to be the same price. Sometimes it goes up to VWAP and then holds and then gears up and goes even higher. So again, they're just used as a reference point. So because I do the counter trend trading a lot, that's the way I look at it. But just to give you a kind of an understanding of what happens here is that when this, we'll go back to Apple. When you got Apple coming down in here and holding this support, this 181 support that we established a few moments ago, when it makes its bounce, the next thing that you're looking at here that's important to you as a trader is profits. You got to make some money. You want to know, when should I sell this thing at the best possible price? So you start walking back up the chart looking at resistances. So you have some like resistance right here. Hope I'm not messing up this chart for you. Just any kind of pivot. This little pivot right here. This little pivot went home. Okay. And VWAP. Now you'll notice what this one did is it came right back up and it kisses that VWAP. This is what this gray line is on my chart. And I also have moving averages, which we'll talk about in a second. But it comes back up in here and it gets rejected. Then it settles back down in and makes this new line of support, and it tries again and it comes back up and it gets rejected. So for the rest of the day, that was sort of like a ceiling for Apple. It just wasn't going to get over the VWAP. So how you work this as a trade, and where something like this will come in to translate it, is if you bought it off of the bottom, your first target is this VWAP. So before you even get started, you can kind of say, if I buy it at, let's say I buy it at 181.50, I'm going to have trouble at 182.80s here is where it was at the time, 183. We'll say 183. Okay. So I get it at 181.50. I might have trouble at 183. So you know before you even get into it that not worried about 185 or 190. First things first, let's just see if we can get to 183. Let's try that. See what it does when it gets to 183. Now when it gets to 183, your senses get turned a little bit higher, because now you want to see what's going to be the behavior. I expect this thing to stop. I expect it to be a resistance. Again, no surprises to you as the trader, rather than panicking going, geez, I don't know if it's going to come down, if it's going to go back up. What am I going to do? I think I'll just take my money. You have a plan, and then you look and you realize, okay, look, it got rejected. That's not a good sign. And it kind of pulled away from that a little bit. But then later on, it tries it again. It's just, look, it's not going to happen. So if you're really wanting this thing to kick it in high gear, it would have to hold that VWAP and then re-gear up through that to make another move. And I think Baba did the same thing. A lot of charts look like that too. Once it sells off, It washes out at a support level, which the support level happened to be from a couple of days back, right here. We'll put it was 148 right down here. You can see no surprises again. Support resistance rules. It just traded right into support from Monday. And then it tries to make a bounce, and then eventually grinds its way back to VWAP. But just like Apple, it wasn't able to get through the VWAP. So you're not going to get that extra kick. Little different story with something like a Roku, right? So what happens here is you get a breakout, and it's really, really common for traders to have FOMO. You don't want to miss out on something. And if you're not in this, you don't want to be left out in the party because nobody likes that. It's always better to wait because, like I said, what you're going to run into a situation here is just one of two things. Either the stock is going to stop and let the VWAP catch up, or the stock's going to come down to it. And this kind of just rolled right into it. Now, they both kind of like the VWAP rose a little bit, come back down there, and it actually ends up sinking lower. So the question is that I ask you, I'm sure traders had some FOMO and they bought this breakout up here. So they're getting long at $99.50 when a little bit of patience could get you long at 98. So where would you rather be long from, 99.50 or 98? And you got a lot of different options being down towards solid supports. But like we said with Apple and like we said with BABA, it traded back to its VWAP, but then it wasn't able to move through it. So later on, Roku comes back up, and you'll see this little spot right here about 2 hours into trading. It starts clustering around it. You know, they sort of get, like I said, two lovers getting attached in the future. Here they are, they're kissing and hugging right here. And then Roku's got to go to work. So once it actually breaks that VWAP finally, look at the move. It goes from this 99 and doesn't stop until the thing is $101. I mean, straight. It just goes straight. Now there's a little bit of separation here. So you'll see a little bit more of this during the evening. So let me kind of not confuse everybody. I'm jumping ahead. My apologies. So when you're looking at something like that, VWAP is normally going to be where the stock ends up, especially in the morning. As it gets a little bit later in the day, there'll be some separation. So when you're looking at an entry point, sometimes rather than be impatient or chase a stock and put yourself in a bad position, just wait for it to either come back to the VWAP or wait for it to settle down. Yes, you will miss a few. There will be always a few stocks here and there that defy logic and defy gravity and do their own thing. It's just that you can't be perfect. It's just not a perfect, like I said, it's a process, not perfection. So you can use it for those, just being patient, a better entry. You can also use it that if you're long something and it's underneath of the VWAP, that's probably where it's going to end up going back to. So you have a little bit of room to work from either the low of day support back to that VWAP for a trade. Or if you're a short seller and you're up here at top, you have a good short at Roku, it starts rolling over. What do you target? You target VWAP. If VWAP goes, maybe it goes back to the low of day where it all started. Stocks will always do that. They don't always just go straight up, even though sometimes you feel like that. And then once they clear VWAP, you've now crossed the other side from a stock that has been, leveled out into an area. Now it's ready to go higher. One thing I would suggest, especially in the morning, is that any time that you have separation like this, or you have this deep, deep separation between the VWAP and the price of the stock, more often than not, it is a bad idea to buy that. Okay? Yes, like I said, there'll be stocks that defy gravity and do their own thing. You'll miss some, but over the course of 50 trades, you'll thank me for this later. Anytime that separation is far like this, it's just not the best move you can make with your money. And it was the same way with even in Roku's case, because here, if you would have bought it at 101.70, yeah, the stock didn't go down, but it didn't go up either. It's just too much separation right here. And anytime they spread, like I said, they're going to connect back together. So at any time they spread too far away, you've got somewhat of a problem. You're reaching a shorter term overbought or a small type of euphoric situation in the market, whatever you want to call it. But keep those in mind there as you're using them. See, same thing with this TTD. It takes off here in the morning, and this is a major break here. I mean, this thing goes 225s to 233s. This is a humongous move, but it does the same thing. It slows down, catches up with its VWAP, trades back through it, and then, just kind of fizzles on out through the end of the day. But once it got back up there, there was legitimate buying opportunity there. You could have done it. It just wasn't in the cards specifically. But two things to take away from these charts is that support and resistance rules. This thing traded right back into support rather than sitting up here buying it at 233. You can pick it up at 225. That's a hell of a big move on a stock like that. And you have some idea of where it may trade if you do pick it up. So if you're picking it up down here off of this level, then you're targeting VWAP. So it's a good way to use it. So when you're looking at the VWAP, how does it work for an entry? Wait for it to come back. If a stock is above a VWAP and you want to buy it, wait till they can connect again. If you miss out, you just miss out. Sometimes you're just going to have to do that. Or if you just can't miss out, you just can't contain yourself. At least when you take the trade, realize that you may get faded back to VWAP. You may end up back there. So at least you have some sort of plan, and maybe you can position yourself better and add when it gets back down to VWAP. There's tons of things that you can do. So you can use it for an entry. You can also use it for an exit if you're a reversal trader like myself and you want to bounce something or you want to fade something, then look for that VWAP as an initial target combined with support or combined with resistance. So now if you take that VWAP and you sprinkle it on top of your support and resistance, you have that much more confirmation and that much more confidence in your trades that statistically you should end up back there. Maybe you don't, but statistically you should. So once the stock starts moving in your favor, if you sell it before it hits VWAP, if you sell it before it hits your resistance, you're basically cutting your throat. In most cases, you are doing yourself harm. And that's not what you're in this business for, because when you think about it, you've done all this donkey work, you've studied, you've rehearsed, you've practiced, you've got this whole stock thing laid out, you've stared at this turd for hours, right? Wanting to know when you can get into it, and you finally get the perfect execution, and now you're going to cut yourself short for just a few pennies of a gain. That's not why you're here. Like, you didn't come this far just to come this far, right? It's nuts. We all do it though. So that's the VWAP. And also for management, if you're under the VWAP and it can't get through that, then you got problems. It's not in the cards. It's just not going to happen that day, or you're struggling to get that done. Maybe it happens later, but for that moment in time, you got what you could get out of it. Now the last ones are simple moving average. I just use 10, 20, 50, 200 moving averages and almost use them the same as a VWAP. I use these less than I use the other two. And again, most of the time when I use these, it's for when I really want to reconfirm something. If I'm having some anxiety because I feel like, man, I don't know, maybe I made a mistake. Should I hang in there? Should I stay? Should I go? Then I'll try to come back over and I'll take a look. So if you're looking at my charts, I got two different setups. I have just one that's completely clean, free of all lines and garbage, just so I can get a quick look at it. And then I can just click over here and I have indicators so I can see maybe something else. That way I get a viewpoint from both. So a moving average, I'm sure most of you know what it is. A moving average is combining the price of the stock versus the time. So on a 5-minute chart, if I'm using a 10-period SMA, that means that's what the price of the stock should be based on that's the average, the average price of the stock over the last 10 5-minute bars. If you're looking at it a daily, that's over the last 10 days. That's the period of time of your chart. So the way I look at that is anytime a stock holds a short-term moving average, like an 8, a 5, an 8, or a 10, I just use the 10 because scalpers normally use tighter moving averages. But if you're holding a line like that, that's extremely freaking bullish. Like if a stock can hold, the shorter the term, the moving average it can hold is enormously bullish. So if a stock just goes up for 4 hours, you know, and never touches a moving average, that's pretty bullish. I usually look at it as somewhere between the 20 and the 50. So I think like, here's a good one. Here's what we're talking about when you're capturing a really large trend. This was yesterday, Apple. So here's your 10 moving averages, this yellow one. I mean, look, this whole time it bounces off of VWAP. How ironic. And support from pre-market. Interesting spot, huh? But this goes from an hour and a half. Here's an hour and a half. Here's the 10 moving average. Never even comes close to it. That's extremely bullish. Now, normally a move like this is very difficult to sustain. Like it's hard for you to come in here and buy at a price like this. In this case, yes, it would have worked. It was one of those days where you had this huge rip rally, and you're going to have those instances. But again, in most cases, this is a bad deal because you've gone too long without any back testing. And it's not, if you just look at this chart, it's not going to go like that for the remainder of the day. If you cut and paste that on top of each other, it's like I said, stocks go up and down, not up or down or whatever. I forgot what I said. Anyway, that's pretty strong. So at some point, just like that, it will retest that moving average, which it does a little bit later. And then this 20 moving average right here is in the green. Now, these usually lead the VWAP, okay? Now, where I find these to be beneficial is the 10 to me doesn't carry much weight. It's just sort of like, well, when you cross the 10, you probably end up at the 20. You have above average chance of getting the 20. So if you're sitting there trying to bounce a flag pattern or bounce a strong stock, the 10 moving average isn't always the best. You know, you might want a little deeper moving average like a 20. Yeah, you'll miss a few there too, but you'll be in a much better position to capture premiums. But most of the time it breaks the 10, it goes right to the 20. Now, a lot of algorithmic programs and institutions like to use this 20, and that's why you'll see stocks often consolidate or slow the rhythm down, okay? And sometimes you're not always looking for a bounce. You're looking for a slowdown spot, a spot where things, you know, kind of level out a little bit and the stock can catch its breath and either make a decision to go lower or re-gear and go higher. So in this case, once you start haggling with the 20, you know, if it can hold that, then the stock most likely won't make it to the VWAP right away. What it will actually do is try to go run back up to the highs first. So to kind of make that a little easier for you, if early on in the day, if your 20 moving average is holding up well and the stock is consolidating around that and it won't lose it, and you see that the VWAP is underneath of that 20-day moving average by a good margin, or just, you know, decent little margin like this, most likely the next move you will see will be another attack for the highs before it tries to catch back up with the VWAP, okay? So it's a little bit more of a front running, if that's lack of a better word, indicator there. Now the 50 to me is something that's used very seldomly, and the only reason that it's on the chart is on an intraday basis. If you find yourself in a scenario where a stock has gone underneath of the 50 moving average, and by chance it's underneath the VWAP too, you got problems there. I mean, you're not done with the butchering that's about to take place on that stock. And if these shorter term moving averages as well are above the 50 moving average, then in theory the stock is still bullish. It's still strong. It's still holding up. So in this case, you know, 10 and 20 stayed above the 50, the stock isn't threatened at all. You know, today that changed. You know, today it starts to stand on top of the moving averages. So if you're just basically looking for neophyte trading 101, is if the 10 and 20 moving averages are above the 50, the chart's bullish. If it's switched upside down and the 50's on top, it's bearish. You know, so you get something like a Baidu here. You know, it just gets absolutely buried under the 50. So when this whole thing starts, as soon as it breaks through the 50, where they're all clustered. I mean, look at the aggressive sell-off here. And the reason for that is not just one of these indicators. If we go back and we look at all three, because you guys want to catch the big moves, you want to say, how do I get at the right inflection point to catch the biggest, strongest, most solid move? It's got these points. Once this thing breaks that pre-market support and you're under the VWAP and you're under the 50 and the 10 and the 20, look what happens to the stock. It just gets annihilated. Now, at some point, it'll come back around again, right? It washes out here, goes back to the 50 moving average. The VWAP. Then the 50 sinks under the 10 and 12. Now it turns a little bit bullish later on. Overall, it's not bullish, but for this period of time after it washed out, after the first 2 hours, that was the low. So yes, there's a trade to be made here. It's just knowing when will this panic stop. So when you're in these trades, this is what this stuff is for, is because when this is panicking, let's say you're in this. Let's say you just screwed up and you're in this and you're like, what do I do now? I'm getting smoked. Right? Rather than just dive out the first thing, take a quick snapshot. Take a quick look. Where's my next support level? How bad could this get? So you go down to your next support level. What if I added that support for a VWAP bounce? Would I be able to get out of the trade? Would that be the right thing to do? If that doesn't work, then where would it go? And then what would I be able? What would my losses be then? You can start to figure this stuff out ahead of time and make the choice what you want to do. You say, or should I just get out of it now and maybe I'll come back to it later when it washes out, finds a support level, and I'll try to trade it back to VWAP and recover my losses that way. So you have a lot of options. Panic shouldn't be one of those. So when you're looking at these, remember, it'll take you some time, and I suggest you start out with support and resistance first. It may sound rudimentary, but do that one first. Just draw those lines out. You'll be amazed how easy it is, number one, for you to overlook something so simple. And then number two, just, get better entries. That's what you want. You want to get these better entries on these stocks and see how they behave around certain areas. Then add the VWAP later and then work some moving averages into it. Just remember that it's never going to be perfect. It's just a little bit here to help you just hang in there. And sometimes that's all the difference that we need. Is just, I know you've been in that situation too, where you just almost cut the loss. You just almost did it, but you decided to wait for 5 or 10 minutes and it worked. And it saved you hundreds, if not thousands. So remember, these add up. Every trade is specific to itself. It's unique to itself. You have to work every trade. You can't give up on any particular trade. By giving up doesn't mean being ignorant, but you have to work each one of these. And if you just cut the amount of loss that you had down by a few $100s, if you do that 10 times, that's like a few grand. So it makes a difference. Every little penny that you can squeak out of this market, it all adds up. It all adds up, my friends. It all adds up, and it all adds up, and it all adds up. So anyway, remember those in closing. I'm going to give you a few things here that can help you. First, I know the ones that attended the last webinar, this DVD's been out for a while. I'm sure most of you probably already have it. But I go into some of this stuff a little bit more in detail with some trading examples. It's free. Right there's the link. If any of you want the DVD here, rock solid, it's completely free. For some of you that are looking for one-on-one real live trading in a trading room, and you want that sort of trade ideas, that sort of information, you want to see this stuff play out in real time, we do have a live trade room. Right there's the link. And there's also, for those that cannot trade on a regular basis, or maybe you can't commit full-time to a trade room and you still want trade ideas or other information, we have this new feed here with StockTwits. It's pretty interesting, and it's a good starting point for most. And then, of course, last is my contact information. If you just want to reach out because you have some questions about a particular trade, or you need some help using these indicators, whatever it may be, just feel free to reach out to me. I'll do my best to get back to each and every one of you. So remember, it's not perfect. It's just like a roadmap. You just got to take a look around you. Most of the time that you're struggling, it's the small things you just got to change. You just got to be maybe a little bit more patient. Just got to take a look around, start with support and resistance first. Just get your ducks in a row there and make sure that you are at the right spot on the chart before you push the button. Make sure you got your plan B, plan C hashed out in your mind. Well, what if it goes down to the next level? What am I going to do? So keep that stuff in mind. I will end it on that note. I want to thank everyone for attending today. If you have questions, just send them my way. I don't know if we're going to do that. I don't know where Scott went. Maybe he fell asleep. But other than that, appreciate it. Trade well.
All right. Thanks, everyone. We will have a recording of this available later on tonight or tomorrow and send you an email telling you how to find it. Thank you, Doug.
Thank you.
Yep. All right. Thanks, everyone.